Hello, everyone. Thank you for joining me for another interview in the Dealmaker Series, where I am speaking with some of the top deal makers here in DFW. My name is James Sackey. I'm joined by my friend and colleague today, Oliver Cohn. He is the Senior Vice President at Bulkley Capital. Oliver, thank you for joining me today. Why don't you give us a quick introduction of you and your company?
Of course. Thank you, James. Pleasure to be here. Thank you for including me. Yes, as you mentioned, I'm SVP here at Bulkley Capital. We're a boutique M&A advisory or investment banking firm here in Dallas, been around for 40 years this year. And we represent founders and family owners of businesses at the low end of the middle market. So, companies that have a valuation of 20 to 100 million is kind of our sweet spot.
Wow, 40 years. I didn't know that. Happy birthday to the firm. That's excellent.
Thank you.
I like that. I had no idea. So let's jump right into it. How would you describe the current state of A and deal making here in DFW or Texas as a state?
Yeah, this is going to be a little bit of a repeat. Seems like the last several quarters, there's cautious optimism around. And, the reason I say that is, it feels like 24 was pretty good. Deals were getting done, but it wasn't quite the huge return to volume that everyone was hoping for after 2 years of declines since 21. But when we talk about kind of Texas and DFW, pretty good traction. I'd say we have a lot of very quality buyer and kind of investor pool here in the local markets. Good number of funded private equity groups, increasing number of fundless sponsors, independent sponsors, family offices, searchers. So I think as an intermediary, a lot of good quality buyers, and it's probably as good a credit market here in terms of number of banks that we've ever had. You see both private equity and credit and banks setting up shop in Dallas or in Texas that weren't here from out of the state. Which all tells you good place to be, good place to be raising capital. If we can drive enough volume of sellers is kind of the question on everyone's mind.
Yeah, for sure. Dallas and Dallas-Fort Worth as a region is, I agree. I think it's probably the second center for finance here in the country after New York. But I think we're getting maybe we're nipping at their heels. Maybe here in a few years we'll see. Hopefully. So, how is the current climate with interest rates and now tariffs have been introduced at the time of this recording and such? How is that impacting deals or deal flow? Is that on many people's minds? What are you seeing?
Yeah, I think there's kind of two different answers there. I think on the interest rates, right, I think that was a participant in causing the decline in deals over the last couple of years. Uncertainty kills all kinds of transaction activity, right? I mean, financial markets don't like uncertainty. And when interest rates not only were getting higher, so costs of doing a deal is more expensive, but you didn't know when they were going to stop rising or where they were going to go. Right? So that was really problematic. I think one of the things that contributed to us, at least at the beginning of this year, thinking things were going to be better this year is at least on interest rates. I think the assumption was, we know they're not going to go up anymore. So they're either going to stay flat, start to go down. So you can start planning, you can start building your kind of transaction sources, capital structure, and know kind of exactly what it's going to cost you to do a deal. Really, it's not necessarily so much the cost of the capital as the uncertainty in the cost of the capital that, gives buyers to, pause. Now, on the flip side, these threats of tariffs, the ideas of tariffs, that's where there's uncertainty, right? And that's, I think, is maybe the cause that, I read that January was the worst month ever in terms of deals, M&A transactions getting done. So I think, people are a little nervous about that. I haven't seen that necessarily people have completely shifted investment strategy because of it, because we don't really know the extent of those tariffs, timing of them, which industries or sectors they're going to apply to. But just the fact that there may be some, certainly would not be surprised, diligence questions, companies we're representing, I know buyers, investors are going to be starting asking about supply chains, about where are you sourcing from, what will be the impact, what are you hearing about tariffs, what if you get hit with tariffs, are you going to be able to pass them along, how much pricing power do you have with your customers? So it's, never a great thing for even to own a business or sell a business if you have the risk of tariffs or the threat of tariffs. So I think that is going to start creeping in. I'm starting to hear people talk about that, ask about it, and like I say, maybe that was part of the reason that we had a bit of a hold back in January that we didn't necessarily expect.
Yeah, yeah, that's what I'm getting as well. And you kind of touched on my next question is how does private credit stack up against private equity? What are you seeing there? I've heard some interesting responses around this question.
Oh,
I'm
okay.
very curious to get your take on it, and I can kind of follow up from there.
I guess in our world, I see those two things as two separate but complementary pools of capital, right? They play different roles in the capital stack of getting a deal done. Where we run into private credit most often is, as part of a transaction, the private equity group is putting in the equity portion of the purchase price, and private credit has been a very flexible and supportive tool for private equity buyers, right? That, especially in times when traditional credit from banks, commercial banks, is either less available, more expensive. And then over the last few years, as interest rates rose, the delta between a private credit cost and a commercial bank cost in interest, narrowed, right? So, and what private credit brings is a lot of flexibility that the commercial banks do not in terms of being an unregulated lender. So, whether it's, easier covenants, looser covenants, a bit more cushion for the operations going forward, whether it's kind of a very low amortization, at least for the beginning of a credit, which then frees up cash flow to be investing in the business and growing until you can then have to start paying back the actual principal. In some ways you can see as a buyer, that's worth paying for, right? In terms of a higher interest rate. And then not to mention, of course, a lot of times that private credit can span both the traditional senior as well as a bit of this mezzanine or subordinated debt leverage in a deal as a one-stop shop to the borrower, to the company. So, as an equity group, you can borrow from one party and get, two layers of debt effectively through one facility. So it's a good tool for that, right? And there's a lot of it out there, right? A lot of funds being raised in that space.
If we kind of separate out into three tranches, if you will, private credit, alternative financing, and then traditional bank debt. Just for the sake of this conversation, what are you seeing amongst those three as far as availability, like the dry powder, right? Or what kind of rules or what's the stringency looking like? And I ask this because a few folks I've spoken with have suggested that, like, there's much more rise around the alternative financing and private credit against traditional bank debt. Like traditional banks are not doing as much business, or they're kind of getting left behind. What's your feeling on that? What are you seeing?
Yeah, I mean, certainly that happened, right, over the last few years as cost of capital for the banks increased, and then they got a little bit more cautious, I think, and conservative in their lending. And when you're worried about the economy and you're worried about how businesses are going to perform, and you're trying to increase your reserves and not have as much loaned out because of regulatory requirements, I think that has definitely happened. I would say in the low end of the middle market where we are, you're starting to see some banks being a bit more aggressive. I'm hearing, banks are open, as people like to say, seeing deals getting done. You're right. It's going to be, at a more conservative structure than a debt fund, right? But it's cheaper. It's, from an interest standpoint, that's still there is a gap there. That's why the private credit funds are filling that gap. They've always been around for the last several years. I think they played a larger role over the last 18, 24 months probably than historically as a proportion of the deals, and it's starting to come back. But yeah, they're still filling that gap, as you'd say, and being a bit more aggressive, and they're structured to be more aggressive. That's their capital is coming from a different place and costing them a higher rate of return that they have to pay back. But I think that's fine. I mean, there's a place for everyone, right? I think we do want to see some of the traditional banks, traditional lenders come back to the table, be back in that kind of lending 2.5, 3 times EBITDA for our kind of smaller businesses, transactions. And that can for a deal that's trading at 6 or 7 times, right? That can be a good portion of the capital structure.
Yeah, for sure. So let's shift a little bit here, more macro. What makes the DFW market or the Texas market unique versus all the others?
Yeah, and I think first of all, I think in some ways it is unique and it has driven, we know there's a lot of, if we have a client that's Texas based, I think there is somewhat of a premium attached to that business in the eyes of buyers. We've sold a lot of companies over the last several years to buyers from outside the state who want to establish a presence in Texas, who want to be here. And, maybe it's the last area on the map that they don't control or they don't have a dot on. So I think buyers, investors, there's something about being in Texas that is attractive in their eyes. And presumably what it boils down to, in my mind, is the scale. We have scale, we have growth, and that growth is both the economy and people, right? Population, right? Which obviously those two are intertwined and drive each other. And then it's a pretty diverse economy. So, you think about Texas as a kind of a state is a very large, we have, four of some of the top kind of 10 or 15 cities in the country. In Texas, so a lot of people, a lot of natural resources, right? So kind of almost kind of a self-sufficient market, relatively skilled labor force. I'd say we seems to be a lot of growth over the last, generation in professional services, financial services, like you said at the beginning of the call, engineering and accounting, that kind of thing, and a diverse economy because of all those things. We're not just a oil and gas play anymore, a lot going on. And so then all those things drive population growth, and all population growth drives investment and expansion. And I talk to people are pretty bullish on, continued expansion of the market. We got a lot of space for people to grow into. So whether it's construction, new companies, consumer spending, right? I mean, it's all driving growth in the state. And obviously where there's growth, there's investment and return to be made.
Yeah, no, for sure. Texas is a very, very, very diverse place, especially here in DFW, for sure. Okay, last question, and this is more of an impromptu one, I guess, or insight based. As far as 2025, what do you think, just as concisely as possible, what do you think this year is going to look like, or what's the theme for the year, do you think?
I'm afraid that the theme might be the perennial, let's see what happens in 6 months' time, right? Which we've been saying for the last 3 years. Coming in, like I said earlier, coming into the beginning of this year, I think most of the people in our space were very optimistic about this year. You should have less uncertainty. We got over the fears of a recession, inflation's tamed, interest rates are staying flat or going down. There's so much private equity dry powder, a couple of trillion still on the sidelines. Private equity has held companies for longer than they ever have before. So there's a lot of push from their general partners or their limited partners, let's just say, to kind of exit some of those deals, which will then create volume in the market, allow them to raise more funds. And so we're all very positive about that. And every business owner I speak to over the last couple of years, their businesses have performed well. And, maybe we're far enough away from the highs of 2021, the high kind of valuations, that the seller expectations and buyer expectations aren't quite so far apart anymore. And people like I can give sellers kind of realistic expectations of what their companies are worth. And so that's, we're all going out until I saw the news about January being a bad month. And, maybe it's this uncertainty around tariffs, potential tax changes. Someone said to me yesterday, it's just, sometimes the investors just say, I'm just going to sit and wait and see what happens. And we've been predicting a big return to M&A 2 quarters from today, every quarter for the last 3 years. And so I really hope it's not like that, because I think we've got a great climate for M&A, right? We've got some very well-performing businesses, a lot of capital, like I said before, and a lot of good quality capital. And it makes sense for people to transition. Everyone has to transition out of the business at some point. And there's a lot of good, viable buyers out there that can preserve that legacy and build on it for the next generations. So, I hope people are going to take advantage of that.
Same, same. Hopefully they will get off their hands and start deploying some of that capital, like you
Mm,
said. Oliver, I appreciate your time. I appreciate your insights.
of course.
It's been wonderful. Hopefully, those of you watching, you can find some of this useful. If you'd like to learn more and see more from some of these interviews in the Dealmaker series, you can find them on my website, jamessackey.marketing, or on my YouTube channel as well. Thank you guys for tuning in.